Hey everyone, thanks so much for joining us today. As David said, we are going to talk a little bit about cryptocurrency and specifically around the tax implications of Bitcoin and other cryptocurrencies today. We definitely welcome your questions, either live or online. Please reach out to us because we want to make this as useful for you as possible. So before we get started, just a quick survey question for everyone. And feel free to shout out the answers for the folks who are in this room. What is your biggest expense, personal expense each year? What do you guys think? You can shout something out. Rent. What else? Taxes. Yeah, so most Americans, and most people all around the world actually spend the number one expense is taxes, much bigger than rent often. So we want to sort of encourage people to think critically about taxes, not only at tax filing time, but ahead of time for tax planning purposes, because it's a way you can actually dramatically improve your own personal financial situation. So with that, I'm going to hand it over to Shehan, who's our resident tax expert, to go through the overviews of how this applies to cryptocurrencies.
Thanks, Chandan. Thank you for everybody who's joining us in person and online. Quick intro of myself and Chandan. If you want to learn more about us, just tweet us from these links. I'm the head of tax strategy at CoinTracker, and obviously Chandan is a co-founder. We'll talk more about CoinTracker and what it can do for you towards the end of the slides. Okay, so in this quick presentation, we're going to cover three things. Overview of crypto taxation. I know taxation is somewhat boring, but there's something that we cannot avoid, so we have to know at least something. And then I'm going to spend a lot of time on tax saving opportunity. That's where most of you guys will have a big interest. And then finally, Chandan's going to tell you how CoinTracker can help you calculate your crypto taxes. Disclaimer: tax laws are extremely complicated. It's long, so if you have a specific situation, just come talk to us offline or consult your tax advisor. Okay, so let's just start with a quick three questions. Have you invested in crypto personally, everybody? Okay, good. Have you ever been paid in crypto? Great. Have you guys received any IRS letters regarding crypto?
Tell us later.
Yeah. Okay, because if you have, we're gonna tell you how to respond to those and how to win those cases. Okay, so now that we know who we are, just want to show you a quick timeline when it comes to the tax compliance of this space. I know everybody's talking about the cool startups that's happening in the crypto space, but this is the boring stuff that we have to know. So crypto started in 2009, 2008 era, and then 2014, IRS came up with their first guidance, and 2019, a couple of months ago, out of nowhere, they issued 10,000 tax notices for people with crypto. So everybody panicked, and we'll show you how we kind of help those clients as well as we go through the slides. And October, last month, they issued new guidance after 5 months of issuance of 2014-21. So we're not going to go through the details, but we're just going to tell you what you really need to know when it comes to your taxes. Okay, so like I said, so these are the guidance we have. The main takeaway is that the cryptocurrencies are treated as property. So it's you kind of owning stocks or land. So whatever the rules applicable to those assets do apply to cryptocurrencies. The cryptocurrencies are not treated as commodities, by the way, according to the IRS. What do you guys think? Is there a special crypto tax? Yeah, that's right. So a lot of people had this misconception that, okay, I had to pay my, special, crypto tax. There's no such a thing right now, but who knows in the future, the government might come up with a new type of tax. So basically, you're paying capital gains and capital losses tax whenever you trade stocks or any other property. You're subject to these, capital gains and losses. So the good thing about capital gains, again, I'm going to go through this very quickly because I want to spend more time on tax saving opportunities. The good thing about capital gains is that you can have $10,000 of gains or $1 million of gains, but you had to pay a tax at 20% maximum rate, so which is pretty beneficial for normal taxpayers, as opposed to ordinary income, which could be taxed as high as 39.6, almost half. So cryptocurrency, especially if you're an investor, when you trade cryptocurrency, that generates capital gains. Especially if you hold that cryptocurrency for more than 12 months, that's going to generate long-term capital gains, which has the highest tax rate of 20%, no matter like how much money you make, which is great for you guys. So getting paid in crypto, I know you got paid in crypto. I know Coinbase is another major employer who that gives that option to employees. So the rule is that if you're getting paid from crypto, you had to include it in income because you're receiving something equivalent to compensation. And then you had to recognize the value as your income, the fair market value at the time of the receipt. So the programs like CoinTracker can help you convert those things to US dollars at every time that you receive those compensations. And make sure you keep the records for 7 years. Again, the key here is that you might not get any tax forms from your employee, but it's your responsibility to record these because you signed the tax return and you had to report your income. So this was the big deal happened last month. Did you guys see these new guns coming up on the news and media, social media? Okay, good. So the big deal about these guns was that IRS issued this after 5 years. As you know, IRS is a very traditional, very old school entity. They're one of the still, few entities that still uses fax. So for them to understand crypto, it takes a long time. So they spoke about hard forks. So the one key thing that we had to remember going forward is that if you get new coins after hard fork, you had to recognize income, even if you don't like that coin, which is somewhat unfavorable, but according to the current rules, that's what you need, that's what you have to do. And the new guidance talks about evaluation and gifting and everything. Again, these are just there. The tools like CoinTracker is going to automate all of these calculations, can help you with these things. But just be aware that the new guidance came in and, CoinTracker, we have all those rules included in our software. So it's just a matter of you connecting your exchanges. We kind of calculate your capital gains and losses and the taxes.
Shehan, one quick question about this.
Yeah.
So I was talking to someone earlier who said that they had only bought and hold their cryptocurrency. They were hodlers.
Yeah.
Do they have to worry about this new guidance or can they just relax?
They can relax. The taxable event happens whenever you dispose, meaning whenever you sell your crypto. So you could put you could have put like $1,000 in 2013 and now it's worth like, I don't know, over $1 million. If you haven't sold it, there's no tax consequences.
What if they got a forked coin or an airdropped coin?
Yeah, so the rule is that whenever you receive that new coin, and if that coin has a value at the time you receive it, you had to recognize ordinary income. Yeah. Okay, so yeah, go ahead.
I have no idea what forks are going on, so
Yeah.
yeah.
So your question is, some
wallets that receive airdrops. I know.
exactly you have no way to track them,
Yeah.
right? I know that's a practical issue that we know because we are people who's in that space, but the IRS doesn't know that. For them, they have set up a rule: if you receive any fork coins, whether you know it or not, you had to recognize ordinary income at the time you receive it. So one good thing that you can do is every quarter, maybe log into your wallets and see, do I see any new coins in the wallets? And if they do, then you had to recognize ordinary income.
Yeah. Just to add to that, so if you have a bunch of wallets and you're getting forked coins or airdrops, or maybe you don't know, great thing is this is all digital native. And there's really awesome tools out there like CoinTracker, which we'll tell you more about, that will automatically notify you if anything like this happens and help you figure out all the tax implications. The alternative is if you want to do it manually, then yes, you are responsible as a taxpayer for keeping track of what those things are. And we realize that that's a pretty big burden, especially when someone random can send you an airdrop without your consent. But that is what the current IRS guidance is as of October 9th.
Yeah.
Can I add one more question?
Yeah, go ahead.
Some coins fork regularly, like every 6 months. And is that considered income every 6 months?
Correct. As long
So the question is, some coins regularly fork, for example, on a cadence of every 6 months. Do you still have to recognize income even if it's on a regular schedule?
Correct. As long as when that coin get forked and when you receive them, it should have a fair market value and you should have the ability to control it, meaning sell or transfer. As long as those criteria is met, then you have to recognize ordinary income.
another great reason to use software to keep track of this.
Yeah, there's virtually no way that you can track this manually. Okay, let's talk about IRS letters, because these are very important, because these letters tell some users, hey, if you haven't reported your crypto, this is the time to do it. If not, we can examine your account and we can open up your account and we can we can ask you to report those things correctly. So these letters came out in 3 variations: 6173, 6174, and 6174A. Again, if you click these letters, you can see what the IRS is saying. I'm glad that none of you guys have received them. In case you receive these letters, just click the IRS crypto tax letter guide, so we have our templates, so you can use those templates to respond to the IRS and hopefully not pay any taxes.
And one thing about this, we actually just recently found out that the IRS has accepted the responses that users of CoinTracker have generated through these templates. So we now have sort of a full feedback loop that if you get one of these notices, respond with one of these templates, and complete the form, then it should actually work out for you.
And people are saying that IRS is going to send another wave of these letters before the end of the year. So, who knows? We'll see what happens towards the end of the year. Okay, so another important thing I want to touch. So starting next year, every 1040 tax return is going to have this, Schedule 1, and that schedule is going to have a question asking you whether you received, sold, or sent, or exchanged, or had any interest in cryptocurrencies. It's a yes and no question. So by adding this question, IRS is trying to gather so much of information, whether you're a crypto holder or a seller, and things of that nature. So that's a very broad question. That pretty much IRS is asking, have you touched crypto even remotely? So that's why this is going to be a very important issue going forward. The crypto compliance, and also relying on the right tools to calculate your gains and losses. Because if you talk to your regular accountant, they wouldn't know how to calculate this. The calculation is simple. It's the amount realized minus cost basis. But when it comes to real world, with so many transactions and fractional ownerships and fractional, transactions going in and out, it's really hard to do this manually. So going forward, being compliant is super important because of this question. Okay, so DeFi. Are you guys involved in DeFi platforms by any chance? Okay, so these are some platforms. You can put crypto as your collateral, and especially if you have highly appreciated crypto, and then you can earn interest. Again, these platforms are not going to provide you with a 1099 interest, which you're familiar with, because typically banks issue them. In this case, again, you had to calculate the interest income in US dollars, and including your Schedule B as interest income. So again, these platforms are becoming more popular, and calculation and inclusion of that income on your tax return is your responsibility, and that's where we can help to calculate those interest income. Okay, Statute of Limitation. So again, important thing here, if you don't report anything, IRS can go back forever in your tax returns and open up that year and ask you to report that income and assess penalties like late payment, late interest, and late filing. So that's why, I know that you could be like a very, strong crypto enthusiast, but it's a good thing to report something. It doesn't have to be perfect, because once you report something, then it starts this statute of limitation, meaning IRS could only go back 3 years after you file the return. If you don't file it, they can go forever. So you're always on the hook for the IRS. Foreign reporting, important because if you don't do these filings correctly, you're going to get penalized $10,000 per occurrence. All you had to do is, if you have any cryptocurrency in a foreign or online exchange, you just had to tell the IRS, hey, I had this cryptocurrency holdings in online exchange. This was the highest fair market value. That's it. It's just a disclosure. There's no taxes. You're just saying the IRS, I have these foreign holdings. This is mainly to combat terrorism and money laundering and things of that nature. Nothing to do with taxes, but it's good to do this to be a proactive taxpayer.
Got a question.
Yeah.
Does the FBAR report apply retroactively, or is that a new rule?
The FBAR report that has been active, like ever since 2014-21. Here's the ruling. So a few weeks ago, the FinCEN is the organization that mandates this FBAR. They said that the FBARs are not required. But as an industry, as a profession, as an economist, we have always been recommending filing FBARs because there's no tax. It's always good to show the good faith than wait until they come back and get you. So if you haven't filed FBAR, that's all right. But going forward, I would file. Tax saving. In the industry, we call it tax planning because we have some restrictions saying these are tax saving strategies. So there's 3 ways to save taxes. You eliminate, you reduce, or you defer taxes. Okay. So the FIFO and specific identification is super important because if you use a software like CoinTracker, you can tell the software to get rid of your unit with the highest cost. So that's where you reduce your gains. And then the wash sale rules is pretty important too, because if you're doing like a regular stock trading, if you sell something and buy it back within the 30-day period, and if you incur a loss, the IRS is going to disallow that loss. But when it comes to crypto, IRS allows that. So let me give an example. Let's say you bought some type of cryptocurrency, it suddenly went down in value. What you can do is you can sell it to harvest that loss and also get back in quickly to hold your position. And this is great for taxes because for tax purposes, you're creating a loss, but in reality, you have a position that's lowering fair market value. And the loss harvesting, Chandan will speak more about it, how the system can automate the wash sales and, loss harvesting rules. The tax data, these are important as well, especially if you're like a trader. Like trader in the eyes of the IRS is somebody who does more than 1,000 transactions. You have your own office with multiple monitors. So if that's the case, you can deduct there's no cap on your losses that you can deduct. And in contrast, if you're like a regular investor, meaning you have a full-time job and you're just doing trading here and there, then your losses are capped at $3,000 a year, but you get to deduct your losses in addition to $3,000 in the future years. Just something to keep in mind. And when it comes to mining, you get to write off your equipment, 100% bonus. These are different provisions of the tax code. You get to, if you use Section 179 in the code, you get to deduct up to $1 million of mining equipment, which is huge. So what that means is you can have a mining operation and you won't have to pay any taxes if you use the tax code correctly. All right, so the final 2 planning opportunities. If you are somebody who got into crypto very early, 2013, 2014, you should probably have a big appreciated asset. And if you need some liquidity, meaning if you need some USD, obviously you can sell it, but if you sell it, you have to pay taxes. So instead of selling that appreciated asset, what you can do is put it as a collateral in one of these DeFi platforms and get USD as a loan. So it's a good way to have some cash liquidity without triggering a tax event. Finally, the crypto self-directed IRA, you can use, there are different vendors online. So what you do is you pretty much trade your crypto in a self-directed IRA account. All the gains and losses are sheltered in that account, so there's no immediate tax consequence. Okay, so Chandan's going to talk a little bit more about CoinTracker and then how it can help you when it comes to taxes and how it can automate everything I just described.
Okay, thanks, Shehan. So basically, there's all these accounting complexities with cryptocurrencies, Bitcoin, Ether, Ripple, Monero. And what CoinTracker seeks to do is take this headache away and automate it in software. So in short, what CoinTracker can do for you is get you crypto tax compliant. And we can also do all your portfolio tracking for you. All the portfolio tracking stuff is totally free. So you should give it a try at cointracker.io. Takes out all the spreadsheets, all the headaches, all of the having to manually check things and worry about whether you're doing it incorrectly or correctly. So hopefully we can make that peace of mind worth it for you. We also support 300 plus exchanges, 2,500 different cryptocurrencies, and we've already served over 10,000 paying users with this product. So there's a good mechanism there. At this point, we're tracking over $1 billion of crypto assets and have a good handle on how we can help people in a wide variety of different kinds of situations. We can also help you work with your existing accountant if you already have a CPA, find a new accountant if you don't have one, or help you self-file if you want to use a tool like TurboTax, TaxAct, or just do it yourself. So just kind of to give you the TLDR summary here, you want to calculate cryptocurrency gains and losses using some kind of well-recognized system. CoinTracker is an example of that. You want to take advantage of tax planning opportunities. So that's eliminating, reducing, deferring different kinds of tax opportunities when they come up. And if you're confused about that, we have a very active blog. You can come ask us questions. You can message us on the website via support. And don't forget to file something. Even if you're confused, even if you don't know exactly what to do, file something. You can always amend it and improve it and get it more accurate over time.
How do you report taxes on income resulting from a loan providing interest accruing service like Celsius Network?
Yeah, so the taxable part is only the interest income. So the interest income, you had to calculate, the fair market value at the time you receive it, and that goes to Schedule B of the tax return.
Why did you choose to start CoinTracker in the first place? What led you to this?
Yes, I was, as David mentioned in the beginning, I was actually a product manager at Google for a number of years, and I worked on a bunch of different things, had a great time here. I saw the power of software, but I also became really interested in fintech specifically. And I had my own crypto portfolio here. Actually, at one point, I worked on an integration between Coinbase and Google. It was a small feature as part of Google Now. So I had my own crypto wallet. I had a small amount of Bitcoin, and I kind of saw that had accrued a significant amount of value over my tenure at Google. I had become more interested in fintech and saw some of the problems with the existing fintech rails and developer tools that are available outside, like to U.S. citizens and developers today. So, for example, we built this tool that would allow you to move money from my own bank account, my own checking account, to my own savings account, and that automated process took 11 days, and there was a 21% fee on that transaction, which was super disappointing to me and really, really frustrating. So it was clear that there was problems with the existing financial system. I was excited about automating different kinds of things using software. I had my own cryptocurrency portfolio. I got really excited about the cryptocurrency space generally and finding different kinds of technological innovations to bring the financial ecosystem and developer tools into the 21st century by taking advantage of the internet. And that got me really excited about CoinTracker. So it was originally a solution to my own problem. How do I make a better financial system? How do I track my own crypto assets? And then we posted it on Reddit, and people started emailing us from all over the world saying, can you add this feature or can you add that exchange? And we kind of have grown from there.
And then just for clarification, do we recognize any sort of taxable event if a crypto holding is forked? If so, how are we supposed to keep track of this when literally anyone can make their own crypto fork?
I agree. So the IRS's job is to come up with a framework, but one of their weaknesses is that they don't understand the practical, what's going on in the real world. But one thing that's going to benefit you is that when you get that forked coin, and if that coin doesn't have any fair market value at the time you receive it, that doesn't create a taxable event. But again, it's your responsibility to track those forked coins, and again, the good practice would be to log into your wallet every quarter, or just connect your wallet to CoinTracker, so then we can flag those things, and you can label them as forked coins. Yeah.
And then, do I need to do foreign reporting if my Bitcoin originated from a foreign exchange but is no longer held there?
No, the FBARs are created when you have holdings in the foreign exchange account, not when it gets generated from a foreign exchange.
So just to add to that, basically, if you had exceeded the threshold for the foreign reporting in the year where the coins were originated, then you might have a requirement in that year. But once you've withdrawn them, that requirement no longer exists. Yeah. Okay. All right. Thank you so much. Really, really appreciate everyone. And feel free to message us online, message us on Twitter, wherever, if you have questions about any of this. Thank you so much.
Thank you.